Welcome to GRE. I'm your host, Keith Weinhold. When will the median U.S. home value hit the $1 million mark? I have the best answer for the exact year that it will happen, and it's probably sooner than you think. Also, there's a big hidden problem in America's housing market today, and no one is talking about it. It's not prices, mortgage rates, affordability, nor is it inventory. I'll tell you about it and more today on Get Rich Education.
Since 2014, the powerful Get Rich Education podcast has created more passive income for people than nearly any other show in the world. This show teaches you how to earn strong returns from passive real estate investing in the best markets without losing your time being a flipper or landlord. Show host Keith Weinhold writes for both Forbes and Rich Dad Advisors and delivers a new show every week. Since 2014, there's been millions of listener downloads in 188 world nations. He has A-list show guests include top-selling personal finance author Robert Kiyosaki. Get Rich Education can be heard on every podcast platform, plus it has its own dedicated Apple and Android listener phone apps. Build wealth on the go with the Get Rich Education podcast. Sign up now for the Get Rich Education podcast or visit getricheducation.com.
You know Mid-South Homebuyers, that top Memphis turnkey provider. I learned that a secret weapon behind their explosive growth is more than just you buying their properties. It's an executive coach. For 9 years now, their CEO Terry Kerr and his COO Pat Nix have worked privately with a coach who I've now learned from too, and he doesn't market himself online anywhere. After 12 years behind the scenes, that coach is now making himself available exclusively for GRE listeners. His name is Daniel Thomas Hind. If you're a hard-charging business owner or investor who wants to get in the best shape of your life, physically, mentally, and professionally, you can fill out an application for a free consult. This is private one-on-one coaching for those willing to go to uncommon lengths to achieve uncommon results. Thanks to Daniel, we've all become better leaders, better operators, and better men. It started by showing up for ourselves. Now it's your turn. Go to danielthomashind.com, H-I-N-D, that's danielthomashind.com, and sign up before spots fill. Flock Homes helps multifamily owners exit the operator grind, whether it's your sixplex or a 50-unit apartment, through a 721 exchange. This defers your capital gains tax. It's a strategy long used by institutions. Now you can swap tenants and toilets for passive income and zero management. Request your initial valuation. See if your property qualifies at flockhomes.com/GRE. That's FLOCKhomes.com/GRE.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
You're listening to one of America's longest running and most listened to shows on real estate investing. Not flipping, not speculating, not whatever the latest hot thing is, but prudent long-term real estate investing. This is Get Rich Education. I'm your host, Keith Weinhold. You've got to believe that you were not put on this earth to live a mediocre life and waddle in the safety of mediocrity. Your investing should be a reflection of that. You've got to believe that you can obtain financial freedom when you're young enough to enjoy it. What would be the point of deferring financial freedom until you're old? Like, what would that point even be? I mean, just imagine a rich, elderly version of you. It cannot buy youth. Youth cannot be bought. Look, right now, if someone offered you $20 million to be age 85 tomorrow, the probability that you would take it is pretty much zero. So then build sustainable, durable wealth now, today, and with a sense of urgency. That's what we're doing here. A $1 million national median home price. When do we get there? Well, back in 1990, the median national home price was about $120K. And you know, funny as it sounds, you can read about how back in 1990, People thought that homes were highly priced, even overpriced, and that maybe they'd need to start going down. Why was that? Well, just 3 years earlier, in 1987, they crossed over 100K for the first time. So psychologically, six figures for a home price, that was still a fairly new phenomenon in 1990. Mortgage rates were 10% then for a 30-year fixed rate loan. And by the way, 10% mortgage rates didn't feel too bad to homeowners and real estate investors in 1990 because as recently as 1984, they were 14.5%. Roll it back a little earlier to 1981, and mortgage rates were over 18% then. And of course, mortgage rates are a friendlier 6 to 7% today. But remember, we're talking about home prices here, and when it comes to the trajectory of home prices, rates are really just trivia. Because as I've discussed here on the show for years, to many people's surprise, mortgage rates have almost nothing to do with home prices, contrary to popular belief. But to those people in 1990 that were still somewhat freshly getting used to six-figure prices that were now 120K, at that time, today's median home price of $429,300 would have sounded as absurd as paying $18 for airport trail mix and $24 for airport beef jerky. Yet here we are. All of those prices are true. That's where we are today. All right, well, from 1990 till today, home prices have nearly 4x'd. So with that backdrop from recent history, what about $1 million? When do we get to that point? Well, home prices only need to go up about 2.3x from here. Yogi Berra said, "It's tough to make predictions, especially about the future." And I want to credit Dr. Lawrence Yun, NAR chief economist, for doing this analysis and sort of getting this conversation started. Because when we look at the national median home price hitting $1 million, this forecast assumes zero price growth for this year, although home prices are now up 1.8% year over year. Here we go. At 3% price growth from today, we get to $1 million in 2056. At 4%, it's 2049. At 5% price growth, it's 2045. And at 6% home price growth, it's 2042. And that's just 15 and a half years away. One part that I really want to credit Dr. Yoon for is that if you take the actual price trend from the last 25 years with all of its ups and downs, which also gives you an average annual gain of 4.5%, by the way, and you project this into the future, that path reaches $1 million in 2048, just over 2 decades away. So taking the past quarter century then and extrapolating it into the future means we hit $1 million in just a little over 20 years. So therefore, perhaps the most prudent and sensible projection gets us there in 2048. But look, it's easy to make the case that growth is going to be on the higher side of these estimates. I mean, just look at what's going on now. Already inflation is over 4%, and there are all kinds of forces that are poised to push that inflation rate higher. I've talked about those in recent episodes. Today, 42 out of 50 states show annual home price gains. Near-term sparks to more home price growth are energy and material price volatility from tariffs and wars, which are poised to push up the replacement cost of homes. And, when your property's replacement cost rises, all capital values tend to rise as well. There's also pent-up demand and still paltry supply in most U.S. regions. I'll get to that, but regulatory costs alone are now $132,000 for a new single-family home. You heard that right. Yes, the cost of zoning and other regs is now $132K, and that figure is sticky. That does not tend to come down. And then you've got these longer-term bonfires, not just the short-term sparks that I mentioned, but the longer-term bonfires that could make million-dollar median homes occur before 2048. This construction of data centers and all the resources that it takes, and chips and copper and electricity, that's all inflationary for our society when we're building that infrastructure. Our currency will keep getting diluted to deal with huge debts like defense and Social Security payment commitments and interest payments themselves. I mean, that part is plain as day. New household formation, that's expected to push up demand until at least the late 2040s. And after that, demographically, things could turn. But the base case remains 2048 here for the $1 million median home. So this $1 million mark, it's not some sci-fi housing fantasy where your realtor shows up in a flying car, okay? Values are already approaching $500,000. And this figure of $1 million, that is just 1,000. It's not some incomprehensibly gigantic number that's shooting for the moon and the stars. So really, the bottom line here is that $1 million median national home price is an almost inevitable destination and is being pushed up by appreciation, inflation, replacement costs, and scarcity. The real question is not whether this happens, but it's when it happens. That's why I gave you the year of 2048 as the base case. I want to talk more about housing scarcity shortly, but first, for some historic perspective, do you want to know how much my parents paid for their home in 1974? I thought I knew the figure, but I wanted to check with Dad, and he let me know, and it was what I thought. All right, first, I think I've shared with you before that my parents still live in the same Coudersport, Pennsylvania home, the old, smallish Victorian-style home built in 1917. They've lived in that continuously since Richard Nixon was our president. And when I go visit my parents, I get to sleep in the same bedroom that I have since I was an infant. Just amazing. Also, do you know that home where I grew up and they still live in, do you know that home is location? Do you know where that location is on what I'll call the urban to rural spectrum? It's interesting. The home is not in a city. It's not in the suburbs. It's not in the exurbs. It's not in the country. And it's not in a planned community either. What's left? Do you know where it might be? Maybe you're thinking too hard. It is in a small town. That's the answer. A small town with a gridded street pattern and a main street that's called Main Street and old brick businesses. It is a standalone community with its own identity and a really slow pace of life. Its population was about 2,600 at the turn of the century, and it's down to about 2,100 residents today. And Coudersport, Pennsylvania is a remote place. It's over 2 hours to the nearest international airport in Buffalo, New York, and there really aren't that many flight routes out of Buffalo either. So for that detached single-family home that does have a big yard, my parents bought it in 1974 for $20,000, exactly $20K, and they quickly got that home paid off back in the day, about 50 years ago. The only financing they had, it wasn't a mortgage in the traditional sense. Rather, my mom's parents gave them a small loan to put toward that $20K, and it was an interest-free loan. And the seller kind of gave them, my parents there, this adjacent grassy lot, practically free. The person that sold it said they didn't feel like mowing it. That wouldn't happen today. Real estate is just more coveted and calculated, I think. You don't just go throw in a lot. And you can guess who had to mow that adjacent grassy lot more than a few times? Yours truly. And hey, I might even mow it again this year when I visit my parents. And my dad listens to this show, and he sure hopes so. It's not a bad-looking home today. I definitely did not grow up dirt poor, but just modestly. There was only one bathroom for our family of four that we all shared. And yes, what this meant was patience, timing, in the ancient art of knocking on the bathroom door with urgency sometimes. And we all took baths only until I was age 18. There was just simply no shower until then. We all shared one car, a Subaru station wagon, definitely not deprived, and a great childhood, just living modestly. Well, today's median home price is now 22 times the 20K that my parents paid for their home in 1974. Homes in Countersport are a lot cheaper, so maybe it's just 12x there. But see, the point is that the home doesn't have more utility because it doesn't have any more than the same 3 bedrooms today. It's got about the same amount of usefulness. They did add a second bathroom. What happened is that our currency has just debased enough to be worth about 1/12 as much as it was in 1974. That's why the price is up 12x. Before I get to national housing scarcity factor, maybe you've always wondered where I get my abundance mindset from since I grew up in a small, simple, remote place. I'm not sure. It's just an internal confidence gain from somewhere. Sometimes I wonder if where I grew up actually contributed to growing my means rather than living below my means, because at some point, subconsciously, I might have thought before that, you know what, if I fail big in life, then I could always move back to old Countersport and own a decent home for just $200K in a town where I know people. Maybe it worked that way. And I moved away from that home for good at age 23, by the way. That's when I left the nest. As you know, I like to say the most important thing here is that I won the parent lottery. Decent, stable, married parents. That means considerably more than inflation or economic factors ever could. 2 grade A parents. Now, getting back to housing's scarcity factor, did you know about what's happening with the available inventory of homes now? After 4 years of rising supply, the inventory trend has flipped. There are now fewer homes for sale nationally than there were a year ago. And this has really thrown off some forecasters that thought inventory would climb about 10% this year. Instead, we have fewer 1 to 4 unit properties on the market today than we did last year. This matters because it could signal the next phase of the housing market. It's important to identify these inflection points right here, if it truly is one, because shrinking inventory, that means fewer options for buyers, more competition, and eventually upward price pressure if the trend holds. But that's not here yet. We haven't seen home prices really take off. A decade ago, there were about 1.5 million available homes. The pandemic low in 2022 is where we hit a jaw-droppingly low 350,000 available homes. I mean, really scraping the bottom. Those were the days when there were 40 people in line to see one open house. That was nuts. Okay, from those scarce days, that has rebounded to 1.1 million available homes the past year or two. And this year, it's stepped back a little to about 1 million available homes for sale in this nation. So bigger picture, today, we have 30 to 35% fewer homes available now than we had a decade ago. And remember, we've also got to account for the fact that we've had population growth since that time as well. That's why demand continues to exceed supply. So really, the housing shortage is a little worse whenever you factor in population growth. So this really speaks to the scarcity, and so does something else here. And there's a big hidden problem in America's housing market today, and nobody, like no one, is talking about this. It's not prices, it's not mortgage rates, affordability, nor is it inventory. It's the fact that America's housing is aging, with the median now 45 years old. That's older than America's homes have ever been. And 45 is also about the median age of a TikTok user's parents, I think. Now, an 80s built home isn't exactly ancient, but this really factors in here. Now, in Buffalo, Pittsburgh, and Cleveland, the typical home predates 1960. In Austin and Raleigh, it is post 2000. So it feels like the Northeast is replacing avocado green appliances and the Southeast is just replacing Ring camera batteries. Because as you'd expect, fast growth areas have young housing stock like Florida and Texas and Tennessee to a lesser extent. And at the beginning of the month, I sent our newsletter subscribers this terrific national map that shows the median age of homes by city, a rare map that's pretty fascinating. And in fact, the oldest homes in the nation are in Elmira, New York. They are about 70 years old, not far from where my parents live in Coudersport, Pennsylvania. And this is such an under-discussed part of the housing shortage. See, a market, it can technically have what seems like available inventory, but still not actually have habitable, financeable, insurable, affordable housing. And older housing stock, that creates friction with repairs and appraisals and insurance and affordability. Harvard's Joint Center for Housing Studies found that 3.6 million renter households, that's 8%, live in inadequate housing with problems in multiple structural deficiencies like water leaks or serious problems with electrical, HVAC, or other systems. And this is a real threat to NOAH housing. Are you familiar with this term? NOAH. NOAH stands for Naturally Occurring Affordable Housing, and it means properties that are affordable purely due to free market conditions, not public funding. What's interesting is that America isn't just not building enough. See, we're also retaining a lot of older homes longer than generations past did. In the mid-20th century, what cities routinely did is that they demolished obsolete housing and they rebuilt aggressively. Today, that just doesn't work in most places. Replacement happens slowly because of higher construction costs and this not in my backyard bickering and zoning restrictions and labor shortages and environmental rules. I mean, it just doesn't work that way anymore. Now, here at GRE, we introduce you to providers across the nation that do deep, extensive quality rehabs, but much of America, they just kind of keep patching their homes like it's a 1998 Honda Accord with 280,000 miles and 3 glowing dashboard warning lights. That's what they're doing. That's why the average age of the home keeps going up. All right, so what are some of the big takeaways for real estate investors with America's homes being older than ever? Number one, it's supply. America still needs more housing. Even in cities with stable populations, a lot of them are going to see more units become obsolete than will get built. That's why when you see a headline like inventory is up, all right, that can be true, but it can also be misleading if it's a 1952 duplex with knob and tube wiring and a furnace that's held together with hope and duct tape. All right, a surprising amount of America's housing stock is basically running on CPR and Lowe's rewards points. The second takeaway with this aging housing stock is that obviously more renovations are required. Again, that is if you're not buying new or turnkey. So therefore, states like New York, Pennsylvania, Ohio, Massachusetts, they all have busy Home Depots. When obsolete properties get renovated, okay, well then rents have to increase to support those costs. And then you know what happens a lot of times? Cynics call that process right there gentrification. Aging homes are going to be a major policy topic over the next decade. There is this tension between keeping buildings affordable and keeping them standing. You can't preserve what's falling apart. But see, then fixing it prices some people out. And then the third investor takeaway with this aging housing is, yet again, the arrow points here one more time, build to rent housing. Yeah, new build rental homes, they're often the way to go. Usually the trade-off for you is that you pay more upfront and then you have fewer maintenance and repair costs. It usually works out for you. And today, this is really tilted to your advantage because home builders are still generously buying down your mortgage rate to perhaps 5%. It depends on the builder. But this is a rare setup for you in this cycle of the market. New property, low maintenance, and mortgage rates that feel like they came from a different decade. You're getting them now. Not only is our housing aging, hey, so are we. The median age of all Americans is 39. Back in 1980, it was just 30. So this is a massive demographic shift in a short period of time. I mean, you and I are both older than we ever have been, of course, and we're both about 20 minutes older than when you and I started talking today. That is why I endeavored to make this show well worth your time. The bottom line with the aging homes is that by most measures, U.S. housing stock is older than it's ever been. New construction has not kept up with population growth, and this is going to shape housing affordability and construction trends and investment opportunities across America, perhaps for the rest of your investor life. I need to tell you about America's worst cities for crime shortly because it includes a lot of cities popular with investors, including cities that we frequently talk about here. So what is going on? This is something that I've wanted to tell you about for a long time. Hey, if you like learning from me, you are in luck. This week and next week, it will be monologue episodes, just you and I together. I'm Keith Weinhold. More for you straight ahead here on episode 612 of Get Rich Education. What if you got your mortgage loans the same place I get mine? You sure can at Ridge Lending Group, NMLS 42056. They provided GRE listeners with more loans than anyone because Ridge specializes in investment property. They'll help you build a long-term plan for growing your real estate empire with leverage. Start your pre-qual and even chat directly with President Chaley Ridge. While it's on your mind, start at ridgelendinggroup.com. That's ridgelendinggroup.com. Let me ask you something. If you've worked hard to build wealth, is your money positioned to actually support your goals? A lot of accredited investors leave capital sitting in cash because it feels safe, but inflation and missed income opportunities can quietly erode its value. Freedom Family Investments offers Freedom Notes for investors seeking structured income backed by real estate. It's a straightforward approach built on real assets, not speculation. And full disclosure, I'm an investor myself. What I like is that their team walks you through how it all works so you can decide if it aligns with your portfolio and income goals. Every investment carries risk and nothing is guaranteed. But with a track record of consistent, on-time investor payouts, they've built real credibility. Go to freedomfamilyinvestments.com to book a clarity call or text FAMILY to 66866. That's FAMILY to 66866.
This is Hal Elrod, author of The Miracle Morning, and listen to Get Rich Education with Keith Weinhold, and don't quit your daydream.
Welcome back to Get Rich Education. I'm your host, Keith Weinhold. America turns 250 years old this coming weekend. That's our semi-quincentennial, which is a word that sort of sounds like it should come with a Latin tutor and a necktie. If you live in the U.S. like I do, happy birthday to us. Enjoy it, celebrate it, be grateful for it. We're living through a milestone that only comes around once every 2.5 centuries. Remember that despite our differences, we still get to live in one of the most remarkable nations ever built. Warren Buffett said, "No one has ever been a success betting against America since 1776, and they're not going to be a success in the future doing it either." End quote. Before I discuss the worst investor cities for crime, Alan Greenspan died last week. Let's learn from history with this long-tenured Fed chair. He served for 19 years, from 1987 to 2006, and then I'll talk about what it means to you. And I actually met Greenspan in person just briefly at the New Orleans Investment Conference several years ago. He led the Federal Reserve under 4 presidents from both parties, and really he was regarded as somewhat of a celebrity economist. He shaped economic policy during this period of massive wealth creation, again, 1987 to 2006, almost 2 decades. Greenspan was hailed for his well-timed interest rate moves to fight inflation, all while promoting economic growth. But a lot of prominent economists, they also blamed his big financial deregulation for causing the 2008 global financial crisis. Greenspanomics were really about entering government during the Ford administration after he co-founded a successful economic forecasting firm. And then Greenspan really became known for basing his decisions on this sort of meticulous data analysis, not textbook economics. And he ultimately gained this guru status for really capable monetary policy, including during one of the longest economic booms in the country's history between 1991 and 2001, all years in which he reigned. And he helped engineer a swift recovery from a massive financial crash during the late Reagan administration. And he did that by slashing interest rates and then pouring tons of money into the economy. And yeah, everyone is popular when they slash interest rate and print tons of money in the short term because that makes everybody feel really prosperous. But I think you know what that leads to. Say it with me. Inflation. In the mid-90s, he presided over rate increases to stem that price growth without causing a recession. And that is a tough balancing act that's known as a soft landing. Jerome Powell basically did that too, despite his faults. But anyway, later, Greenspan didn't pay attention to people that wanted him to keep jacking up rates. But he got it right to hold off from doing that. There was an economic upswing because Greenspan correctly predicted that we'd have all these productivity gains from personal computers that would help tame inflation. He got that part right. And Greenspan, he was famous for using these hard to decipher pieces of jargon known as Fed speak. I mean, it was unforgettable. In 1996, when he dropped the term irrational exuberance, so that really just means these unduly escalated asset values. And he also pioneered these interest rate change announcements as a way to help guide the markets instead of surprising everybody. But on the other hand, anyone that shapes the economy is going to get some criticism. A lot of people said that Greenspan would just always rescue the stock market, and investors sort of knew that he would come rescue it, and that made investors make these riskier and riskier bets. He was an acolyte of libertarian Ayn Rand, and so Greenspan lobbied for this sort of light-touch financial regulation during the Clinton years, and that, combined with his refusal to raise interest rates and rein in subprime mortgage lenders to stamp out the housing bubble in the 2000s, that's really what caused people to say that he was partially responsible for the global financial crisis. His influence definitely remains today. Alan Greenspan lived from 1926 to 2026. Now, we've all seen those lists like America's worst cities or the highest crime metros in the U.S. floating around on social media in articles like Newsweek's published for decades and everywhere in between, right? It's like the 10 places where your wallet, your hubcaps, and your will to live disappear. Something like that, in some form. When you consider real estate markets that you want to invest in, the quality of the area absolutely matters. A bad neighborhood, that's going to contribute to stagnant rents, flat or declining values, higher vacancy, and you'll probably attract a tenant who treats your property like it's a borrowed jet ski. All right, not where you want to be. But a faulty modus operandi is that a reader, they often see a list like this, and then they extrapolate an area's crime or their public safety issues and blankets them across an entire city. Now, one of these lists came across my desk recently, the 50 worst cities to live in the United States, and the cities are ranked. And here's what struck me as wild, paradoxical. At least 7 of the top 8 cities have areas with strong investment fundamentals, actually. So the 8 worst in order are Detroit, Memphis, Jackson, Mississippi, St. Louis, Baltimore, Cleveland, Shreveport, Louisiana, and then 8th worst is Birmingham, Alabama. Most all of these have good investment pockets in them. Now, I've never visited Shreveport, so that's one that I can't speak to. All right, well, what is going on here? Why am I calling them good investor cities if they all make this list? And by the way, I was born in the 34th worst on this list, Reading, Pennsylvania. One of my degrees is in geography, and I get out and see the world. And what's weird, and you'll see this over and over and over again in society throughout your life, and that is when people talk about their own city that they live in. Oh, they understand the nuance, okay? You know your own city has posh areas and rough places and working class areas, and that city that you live in has improving neighborhoods, and it also has don't stop there for gas after midnight areas. But see, when there's another city that people aren't familiar with or they haven't visited, well, then suddenly the entire area gets slapped with one label, like, oh, that's nice, or that place is a dump, or the world would be better if that entire city slid into the ocean. Well, that's lazy thinking. Almost every city has sections that they're proud of, and then, well, the garbage collector has to live somewhere. Take Memphis, for example. It has long been one of America's most real estate investor-advantaged cities, and it is a favorable place for income property owners because it's got landlord-friendly laws, a deep base of blue-collar distribution jobs, a high ratio of rent income to purchase price, and Memphis also has such an embedded renter culture that tenants' appliances actually move around with them. But yet Memphis, like I said, is a dreadful number 2 on this worst cities list due to high crime. Okay, that's the problem with citywide statistics. Bad neighborhoods can skew stats for an entire city. In fact, since we just mentioned them here on the show last week, take a reputable Memphis-based income property provider like Mid-South Homebuyers. They renovate and provide investors with property in neighborhoods like Fraser and Whitehaven. But wait a moment, you can easily read about crime and blight and disinvestment into these same exact 2 Memphis neighborhoods, Fraser and Whitehaven. That's real, and that is accurate. And simultaneously, Fraser is anchored economically by nearby world-class hospitals, a massive Amazon presence. You've got Nike's largest distribution center in the world. I mean, that's not exactly a tumbleweed economy. Drive down Fraser's Pamela Drive, and you're going to see an established, leafy, middle-class neighborhood, mostly built in the 60s, with these modest, well-kept properties. And you can see that if you pull up Pamela Drive, Memphis on Google Street View. And they're often 3-bed, 1-bath ranch homes, about 1,000 square feet in size, with 0.2 of an acre lots. I mean, everything I just described there is ideal for cash-flowing rentals. Driveways, lawns, normal life. It's not posh, but pride of ownership is apparent here. People mow their lawns, trash stays picked up, you see orderly cars, maybe a jogger or a baby stroller or a neighbor watering flowers. You do not see dumped furniture, no cars on blocks, no front yards that look like a failed episode of Storage Wars. Community stalwarts live here, like our police officers, nurses, public school teachers. So, see, there's substantial variation in investability even within Fraser and Whitehaven. It's almost a block-by-block phenomenon even within one neighborhood. So to mentally stigmatize every neighborhood in greater Memphis as bad due to their high crime areas is a really gross aberration. So when one isn't familiar with an area, there's often an inclination to broad brush stroke it all. I mean, gosh, I wonder if people in Kazakhstan think that you're an abject degenerate simply for sending your child to school because they read that America has lots of school shootings. See, it's the same principle here. And just like any provider the GRE tells you about, Mid-South homebuyers wants you to visit their neighborhoods in person. In fact, they frequently arrange investor tours and even welcome your visit so much that you'll get a $500 credit on your first property for attending the tour. They will pay you to come see Memphis effectively. And bigger picture, national crime rates of all kinds just keep plummeting because everybody is on their phone. Frankly, a lot of places on worst cities lists like Memphis, they can be dangerous to invest in without a free consultation from our GRE Investment Coaching or a resource like Mid-South Homebuyers. So the bottom line is that investors, they don't buy a city. You're going to buy one specific house on one specific street with one specific tenant profile in one specific property management system. Micro locations are what determine your ROI. And by the way, Mid-South Homebuyers has good income properties, some of them for about $200K or under $200K. And right now they're offering investors their 555 program. This means they buy down your mortgage rate to 5.5% or maybe a little lower and have a property management fee of just 5% for the first 5 years on every new turnkey property purchase. That is currently one of the best deals in the nation for income property. You can learn more at midsouthhomebuyers.com if that sounds interesting. Hopefully, you've learned about real estate today, and I've helped clear up some misconceptions. $1 million median homes are not some far-fetched fantasy. 2048 is my best guess as to when we reach that point. Housing is more scarce than you think, especially when you consider that America's homes are older than they've ever been. And when we look at one city's crime or demographic statistics, that broad brushstroke's quite a wide area. Hey, if you enjoyed today's episode, there's a way to get more out of it for you and others. That is by telling 2 friends about the show. I love it when you do that, and I'm grateful for it. Text them this episode right now. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.